Monaco 64, home of alternative economics and contrarian views. So recently I had the pleasure of speaking with Patrick Karim and Kevin Wadsworth. They run Northstar Badcharts. They have a big presence on Twitter, Patrick and Kevin, but they also have a website, northstarbadcharts.com, and they do great technical analysis. They also have a YouTube channel that, frankly, I think needs a lot more subscribers and more views because their technical analysis is great. I think, yes, not everyone is keen on technical analysis, but Patrick and Kevin do a great job of going back decades, sometimes around 100 years, to show investors where things like gold or silver are in terms of being overvalued or undervalued. And of course, you can apply that to anything, not just gold and silver. They also look at the short-term movements in the technical analysis field, of course. We spoke about fundamentals as well, because as many of you know, I love technical analysis as well, but I also think fundamental analysis complements technical analysis. Of course, Kevin and Patrick do purely technical analysis, but we had a really nice chat. We looked at gold, silver, and other securities. We spoke for about an hour. We probably could have spoken for many hours, but we had to have a time limit, so to speak. So yes, make sure you check out their website. They provide a service for a fee, but they also provide videos now on YouTube, and they're also active on Twitter. I recommend you follow them. They have a lot of followers on Twitter, but not so many followers on YouTube, and I think they deserve a lot more. And I have to thank one of the viewers about a week ago for sending me a link of their latest video where they look at the long-term picture, not just for gold and silver, but also for interest rates, for the 10-year yield, for the relationship between nominal yields and the real yields. They do some really good work. So without further ado, here's my chat with Patrick and Kevin.
So I thought today we'd have a little bit of a general chat and discussion just about the general markets and some of the charts that me and Patrick have been producing over the last few days and weeks, and I think one or two of them caught Mario's eye, and has just been discussing some of the macro charts, particularly to do with what's going on in the commodity space, I think, at the moment. And I know you cover a very wide variety of subject matter there, Mario. So which chart, can you recall which charts perhaps it was that you're particularly looking at of ours, and I can probably pull those up?
Yeah, I mean, one that I thought was really interesting was the very long-term silver chart, where you kind of changed my views a little bit about how silver has done over the years, because we get bogged down on the $50 level. But looking back, I think it goes to the 1930s. Yeah. It actually shows that silver has been constantly rising and the dollar has been constantly falling.
Kevin, you want me to show that? Because I know exactly what
yeah, Patrick knows where it is. It's be on our website, so I'll let Patrick find that and share his screen. And
yeah, it's you're so right, Mario, because honestly, as humans, it's always people, the Hunt brothers, the $50, and guys, we've never went up, even 2011. But I did a chart, and I could even do it. Okay, sorry guys. Stare at the octopus while I find the chart.
I've got my end of Fed mug.
All right, check it out. So, okay, I could even do it here, I'll do it live. But this is the, okay, so I'll remove all indicators. Okay, so this is the silver chart. I'll move the pictures since forever. I'll put it line chart. I'll even put it log. Yeah, I'll put it log. So people look at the peaks, right? And then they say, look, we're barely here. But if you take, there's a few ways you could do to remove the noise. You could either do just a rising trend line, and then you know that over 100 years, 80, 90 years, silver has been doing higher lows constantly all the way up. Here was probably the last greatest entry was probably 2002 right here. And it's been just going up. I could even add a moving average, add indicator. And this is quite the most revealing one. Or you know what I'm going to do, guys? I will do something. Where is it? Here it is. I'll do something else, Kevin. It's like, you know, when you watch these recipe shows where they have all the ingredients and they're starting to work with it. And then out of the oven for a recipe that's supposed to take 3 hours to cook. Oh, it's ready.
And Patrick was about to draw the chart there, and he's got one that he prepared earlier.
Yeah, it's going to be easier.
Yeah.
Because I know exactly which is the chart that I want to show. Okay, here it is. So this is not the one that Mario saw, but this, guys, is the 16-year moving averages for gold and silver. So if you remove those peaks, people say, oh, silver is not above its all-time highs. Look where it is, gold and silver, they're moving average. They're way higher than what they did in the 80s, way higher. It's like, the trick is with silver and gold, you just want to buy on the huge drawdowns when they start turning up, right? That's when you really want to load heavy. But after that, you just want to ride it. You don't want to buy these peaks. That's when TA comes in, right? For the time. Are you in the bubble versus the SPX? Or have you been spiking like crazy? Like when your neighbor's talking to you about buying silver, you probably should think about trimming down, right? But overall,
and I guess if you really like silver, you know, as a metal to hold as well, when you get these spikes, like you just said, your neighbor's talking about it. Maybe if you're looking to acquire another asset or need to pay some debt, maybe unwind a little bit the silver, but it doesn't mean you get rid of all of it, I would say.
Exactly. You don't have to, those extremes, you trim down. You don't want to, because you don't know. What if it keeps spiking up and keep going crazy, right? You want to scale out slowly and you want to scale in probably slowly, just in case your timing's a little off, you know, so that's a big thing for everybody who says silver hasn't performed and gold. Just look at this chart, guys, and look at the long-term moving average, and you'll see that it's,
have you got like a logarithmic of that one? I guess not.
Yes, I do. Yeah. Okay. So I'll come back to my,
this is a good one too. I like this one as well.
192, 16 years is going to be what, 192 months. Now here's the moving average. What I like to do is I like hiding the price action, and here it is. So that's what the moving average has been doing. Wow, look at that, Kevin. Pure, look at that. Look at that. 16, pure moving average, just going up and up.
So I guess there's probably pretty good support around around 12 now, isn't it?
Yeah, you see, people get very emotional about the spikes up and down in silver and, well, all assets, I suppose, in particularly commodities, which can be very spiky in nature. They go up very quickly and they come crashing down very quickly, a little bit like cryptocurrencies. But you know, when you take the noise away and you look at the underlying trend, it from an investment point of view, it removes a lot of the fear and puts the whole thing in perspective. So, you know, if nothing else, technical analysis helps you to sort of analyze whether you're actually in the right market or not. You know, you can compare one market to another, whether it's commodities to the SPX or whether it's tech to agriculture or real estate to whatever. So, you know, it does allow you to pick the market that's in the greatest, strongest uptrend and just ignore all the spiky bits, which are really background noise, a little bit like tuning into a radio station. You don't want the interference. You want to actually listen to the actual conversation that's going on. So you have to tune it in and get the clear picture.
Yeah, it's just insane. Even here, gold, Mario, man, this could be probably the last, like when those moving averages are close together, that means the shorter term price action has slowed down just enough to let the longer term moving average just pick up. So here you see the 8-year moving average. So all that 5-year or 6-year bear market we had from 2013 to, well, let's say 2018, 19, that just permitted that long-term moving average just to slow down, to compress when nobody wants gold anymore. And these are actually great. It's like you could have used a Bollinger Band, but these are actually great buying opportunities when you're not stretched. Here you see 2013 getting really stretched. Here it's coiled and tight. Here, that was 2006. Wow, that was another great area here, 2006, 7.
Yeah.
And yeah, and it even started turning right ahead of time. Here you were stretched. That was probably the 1980s.
Yeah, I mean, this is not something I looked at back, let's say 2002. That's when I first bought some Krugerrands. So, and I guess that short-term moving average was below that black. So that was a good time to buy.
Yeah, and in terms of making a decision about what's going to be driving commodities and particularly precious metals going forwards, you really do need to compare what's happening now with what's happened in historically speaking. So there's a chart there that I'd probably quite like to show if I can.
Okay, I'll stop sharing, Kev.
Yeah, okay. Just at this point, there's a chart here. If I share my screen.
While Kevin finds that, Mario, so for the fundamentals for you, because remember the fundamentals, are you saying the same fundamentals that were there in the gold top in 2011 to 13? Is your narrative the same as it was back then, or it's amplified, or have you changed a little bit the way you were thinking back then? Because that was.
I'll go back to like 02 if you don't mind.
Yeah, please.
One of the reasons my wife and I thought about buying some coins was that our pension had dropped. My pension had dropped quite a bit, my private pension, because of the dot-com bubble and the stock market correction. So we thought, oh, let's buy some gold. And then I started looking into gold. You buy, a gold coin, and it's really special if you never held it. And then I was looking into the Austrian School of Economics, sound money. And then I heard Ben Bernanke's speech, helicopter speech. And I thought, this guy is crazy. And I knew back then that he was probably going to be a Fed chairman. And I thought, wow, this is, and the Japanese had been doing QE, and he said, we'll never allow deflation to take place. When I heard that, it rang alarm bells. As for 2011, 2012, I mean, if you look at it, gold had gone from around 680 in 2008. We had that big sharp correction during the Lehman collapse from like 1,000 in March 2008 to around 680, and then it rebounded really quickly and went up to 1,900 in about 2 years or something, 2.5 years. And looking back, yeah, it was probably overbought, but I still believed as a long-term investor holder that it was the right place to be. But yeah, it was difficult to say. In hindsight, it's easy to say, oh, that was the top and you should have gotten out. But yeah, the fundamentals, though, I think have really amplified ever since 02, because they've just kept increasing the balance sheets, the central bank, especially since 2020. And right now they're trying to unwind everything. But I think they're going to have a tough time. The Fed has barely started, and we're seeing a lot of volatility and interest rates rising, yields rising very quickly. So, yeah, I think it's amplified even more.
Yeah, well, with gold, I mean, there's one thing that investors do need to be aware of, is the cyclical behavior of the gold market. It has a significant low point every 8 years. So in 2016, that was a low point in the precious metals market. Prior to that, 2008 was a low point in the precious metals market. Prior to that, 2000 was a low point in the precious metals market. Prior to that, 1992 was a low point in the precious metals market. And prior to that, you know, and you can go all the way back to when gold came off, when the US came off the gold standard. And so that repeating 8-year pattern, if you're into investing gold, the time to add to your investment or to take an initial investment is at the 8-year cycle low. So the last 8-year cycle low is 2016. So the next one is due in 2024. So that's a very important point for precious metal investors to keep in the back of their mind. The other thing that this chart, which we put together, really demonstrates is the fact that we are seeing a combination of factors that we haven't seen in 50 years.
Kev, hold on. Are you sharing your screen? I'm not seeing anything yet.
Oh, right. Okay, Pat. Sorry.
Yeah. The other, the 8-year cycle low, does that mean you think there's going to be a major top before 2024?
Yeah. So do you see that? I'm checking. You see the screen now?
Yeah.
Yeah. Okay.
Well, I really like that chart as well.
Yeah.
After the silver one, you know, this correlation between the 10-year yield and the real yield is a really good thing to look at.
It really illustrates that there's a lot of factors at play in combining to help gold rise rapidly, and it's not just any one element like the US dollar index, for example, or the 10-year yield. There's a whole combination of factors at play, and this is some of the key factors, I suppose. But as you can see on the gold chart there, 2016 was a low point. Yeah. 2008 was a low point. 2000 was a low point, and 1992, and you can go all the way back, as I said, to when the US came off the gold standard. But the 10-year yield is the bar chart at the top of this graph here. And you can see that throughout the 1960s and 70s, the 10-year yield was rising until that point in 1985, when the 10-year yield made a technical breakdown. The support line that had supported its rise all the way through the 60s and 70s was broken. And that was what I'm referring to as a paradigm shift. It was a shift from an inflationary environment to a disinflationary environment.
Yeah.
So the last 40 years, despite temporary upticks in inflation, and the green line is the inflation rate. So despite temporary upticks in the inflation rate, the trend has been from way up here to way down here. Okay, so inflation has been controlled and pushed down and subdued. That changed very dramatically just recently, of course, when inflation began to take off very, very quickly. And of course, we were being told that it was transitory. Now, fundamentally, that didn't make a lot of sense. And technically, it now makes even less sense, because technically it is accelerating at a rate that is, by some measures, even faster than the 1970s. The PPI, for example, across most European economies is accelerating at an angle that is beyond what it did in the 1970s, the producer price index, which of course will feed into the consumer price index if these levels remain elevated for long enough, which they already are doing. So the 10-year yield has broken out, and what's happening is that, sorry, I beg your pardon, the 10-year yield has broken out, but the 10-year real yield, which is the blue line, so this is the 10-year yield adjusted for inflation, because obviously inflation is a big factor. The 10-year real yield is plunging. So whilst the yield is rising, the real yield is plunging. And that's because of the green line, which is inflation, is taking off like a rocket to the moon. So
faster than the yield, I guess. Yeah,
absolutely. So what you're looking at is the tidal wave of inflation is completely wiping out everything before it, and is having these effects that we haven't seen since the same factors combined in the 1970s. Something else you can look at here is the correlation between the 10-year yield and the 10-year real yield. So this Spearman rank correlation coefficient, it ranges from +1, which is a perfectly correlated positive situation, meaning both the 10-year yield and the real yield are moving exactly in the same direction, and a -1 reading, which shows that the 10-year yield and 10-year real yield are moving completely in opposite directions. So you can look at the 1970s, and you can see that we had these red bars on the correlation coefficient reading that go all the way down to that sort of -1 kind of level, which means that they're going completely in the opposite direction. And that eased off for a little while, and it came back with a force. So there were two very clear inflationary periods in the 1970s with a bit of a breather in between. And that's when gold went up. It doubled again, it doubled again, it doubled again, and then it rose a bit more. So of course, if that was to happen today, you'd be talking about gold well north of sort of $10,000. So the
I guess, can I interrupt you just a second?
Yeah,
I guess that that corresponds with the my fundamental view that the fundamentals are even more amplified now, because if you look at in the 2000s, even though the inflation was under control somewhat, it was disinflationary period, gold still went up 200%. Or
absolutely.
even more, 400% from like 2001.
Yeah.
And now with inflation taking off, it could even amplify the move in gold. And the thing to watch, though, I guess you mentioned that in your video, is where the 10-year yield closes for this quarter. If it closes above that line.
And there's an issue here with the 10-year yield, which economists, I suppose, have different views on. And I'm not an economist, I'm a technical analyst, but it intrigues me how the 10-year yield breaking out can be at all sustainable unless we have incredible inflation, because the 10-year yield isn't just this chart isn't a chart for the price of bananas, as I keep saying. It's a chart that has a resistance line that I've referred to as the pain line. And I can go back to a chart on our website here, and I'll try to, if you just give me a second. And let me just find the right chart, because I know it's here somewhere. I think it's on page 1. Okay, and
too many charts, Kevin. We have to slow down.
We're showing out too many. Here we go. This is the 10-year yield chart.
There you go.
Okay, so just if you step back for a moment and think what this chart is representing, there's a support zone underneath, which is fine, and there's a resistance line on the top. But throughout the last 40 years, the 10-year yield has trended downwards. Now, to my mathematical brain, there's a very good reason for that, and it's because the US debt has gone upwards in the opposite direction. So the mountain of debt has been rising, and that by definition must mean that the yield that the United States can pay on their debt has to go down, because as the trillions increase on the US national debt, to finance that debt at 5%, 6%, 7% now isn't as feasible as it was 30 years ago, when the debt was that much lower in relation to GDP. So it's not the debt, the outright debt, that is just the issue here. It's the actual debt to GDP, the proportion of debt compared to the gross domestic product. And there's an equation there which must be very complex, I'm sure, but we don't actually need to worry about the equation itself, because it's represented in this resistance line. This red line is telling us as technical analysts where the pain is reached. And if you look at these points here, the pain is reached when the 10-year yield hits that line, and it turns down very sharply. And each time it does that, something not very pleasant tends to happen. I mean, we've got the 2008 financial crisis there.
Yeah.
Around about 2000, we know what happened around about 2000 as well. So what's going to happen here is my question. And if it does rise that line, how do they make the maths add up?
They'll be in trouble if that you don't get the move lower here. And I think most mainstream Keynesian central bankers, Wall Street, City of London guys expect it to go down for the game to keep going. But I've looked at some cycles as well. I don't know if you've looked at the bond cycles, and even the movement of the planet, which is kind of strange. But if you go back to the 1940s, I think it was just before World War, the US, around the time they went into World War II, 41, 42, the 10-year yield bottomed, I think, just under 2%. And then for the next 40 years, it went up to 1981, 82 at 15.5%. And then it went down has been going down since 1981. And you could argue that 2021 could be the 40-year, that things are turning. And there's also like a 20-year cycle. So I don't know. There's a lot of, I think the central bankers and governments and the bankers, they're hoping that yield turns down. I think it's going to be the most important thing to look at, I think, for the financial markets.
Also, we've got the Fed meeting coming up, haven't we? And the Fed decision on interest rates is going to be quite intriguing to see, because the markets are going to have a little bit of a fit, aren't they? I suppose, if rates are indeed lifted at the sort of rate at which they've previously proposed.
Yeah.
Kevin,
sorry, go ahead.
well, I had an idea now. If what's the pain line if you would draw it on the real yields? Because I'm curious, because maybe it's the real yields that breaks markets. Maybe they won't mind. Maybe that chart will break out the 10-year yields, right? But if there's so much inflation outpacing this, even if the interest rates are going to 3%, who cares if there's 20% inflation, right? They're going to inflate the data away. The GDP is going to look bigger, right? Because the inflation, I think it's a big component of the GDP. So I'm curious to see if there's a pain. How high can we ever go back into real yields positive? Maybe that's when like everything breaks down, when we go. I don't know.
No, that's a good point. I mean, and I think into 2018, the nominal level was about 3.25, the 10-year yield. And then all of a sudden everything turned and it started going down. So I would say now as well, 3.25 is going to be the important nominal yield. But like you said, if inflation keeps rising or CPI keeps rising,
so
who knows?
Can you see my screen at the moment?
Yeah.
Yeah, so that's the 10-year real yield. I just get Patrick to double check and confirm that, because I've
yeah. Well, essentially, it's the 10-year yields divided minus the inflation rate. So it's the closest we get. It's not the 10-year break even or some type of
yeah, some people
tips.
look at that, but that's like using the tips, and the tips are manipulated by the central banks, and according to them, the real yield now is almost zero. But I think it's better to look at this.
Yeah, well, if you do it this way and take the 10-year yield over the inflation rate, which is what we've got here, I always like to just double check and make sure I know what I'm looking at. So it's the 10-year yield over inflation, or taking the inflation rate into account, then it's deeply negative and it's broken down.
Yeah, I think fundamentally, if they, for example, if the bond market stabilizes and nominal yields start going down, but inflation keeps rising, I mean, that real yield could drop even further, and that could be really bullish for hard assets.
I mean, you can do that.
I see that being hard, because if inflation is going up, I find it hard that yields are going to turn south, nominal yields.
Yeah. I mean, you can do the math quickly in your head, can't you? Because the inflation rate is what, 8.5% at the moment, and the 10-year yield is, can you remind me what's
2.7 right now. I mean, it's come off the last few days.
So that figure of about minus 6.4 is there or thereabouts, isn't it? So the real world real yield, if you want to put it that way, is deeply negative.
Yeah, we're at 274 now, the 10-year yield. It's down 9 basis points today.
Yeah. So, of course, a falling real yield is, traditionally speaking, sort of rocket fuel for precious metals. It certainly doesn't do any harm, does it, to have the real yield falling away for precious metals?
Mario,
if I'd been asleep for 3 years and someone showed me that, I'd say gold and silver should be a lot higher. But
Well, we have a chart for that. Look, Mario, we're going to show a chart, and hopefully, maybe your viewers start catching on. But I've spotted this chart, and now Kevin's doing it. It's the U.S. dollar inflation adjusted. Okay, this is it. Okay, this is my theory, Mario. Try to knock it down, because I think I just understood. Sometimes people, they do gold, adjusted inflation gold, and they say it's super cheap. But
we have to be
my reason.
Yeah, I was just going to say I have to be a little bit careful, because this is the US dollar index adjusted for inflation.
It's mostly euro, isn't it?
Yeah, so it's about 60% euro, and you have to stop for a second and just think how you interpret this, because it's not the dollar adjusted for inflation, it's the dollar index.
Yeah,
so it's that whole basket of currencies in relation to the US dollar. But what I noticed, and the key point, is these breakdown points when they occur. So when the US dollar index adjusted for inflation makes a sudden break to the downside, it's during a period when precious metals thrive effectively, and it's that breakdown point that is key here. And also, as the dollar index adjusted for inflation continues to fall, how precious metals perform during that period. So even in a disinflationary environment, during these past two breakdowns, gold performed exceedingly well. Of course, we know it went from $250 to $2,000, so sort of 900% rise in a disinflationary environment. So in an inflationary environment, if that's what we're entering, and it does appear that way to say the least, then you can only begin to imagine what may happen.
Yeah, I mean, I have an opinion on the dollar index, and I've done quite a bit of technical analysis long term on the dollar index, and it seems to have also like an 8-year cycle bottom, like gold, and and also top 8-year top and bottom. And I noticed that 2017, January 2017, it topped at 103.84. So I know right now it's fairly strong, but I don't see it making a new high, and I see it bottoming sometime in like 2024, 2025. I don't know if that corresponds to your analysis. The other thing about the dollar index, it was used after the fixed rate regime of Bretton Woods collapsed because they had to measure the dollar against something. There's no gold, so they measured it against other fiat currencies, and they started measuring it at 100 in 1973. And here we are, 50 years later almost, and it's still around 100, while gold went from 83 back in 1973 to now 1900. So I think it's a bit of a distraction, the dollar index, to be honest.
Yeah, well, because the dollar index is rising, but the dollar adjusted for inflation isn't.
Yeah.
But what I wanted to show you here was how and you tell me if you sort of broadly agree with this. I mean, yes, you can pick out the cycles on very clearly, actually. The US came off the gold standard in the period sort of around 71 to 73. And then there was a period of the US dollar kind of finding its place in the world, or the US dollar index finding its place in the world, and the sort of valuation against the British pound, Japanese yen, the euro. Well, the euro, of course, wasn't around back then, but the
Deutsche Mark,
the Deutsche
French
Mark.
franc, Deutsche Mark.
And what we saw was a very, very sort of parabolic almost run up in the dollar. And my suggestion is that this end phase of the rally in the US dollar index in the 1980s was a blow off top. So a lot of analysts will draw their US dollar charts using that top, and they'll have their resistance line starting up here somewhere. But I'm viewing that as unrepresentative. And if you do that and view it as unrepresentative, then this period here, around about 2000 to where we are now, allows you to be a little bit more, you can place the resistance line much closer to the current price action. But regardless of that, you can pick out the three very clear cyclical peaks in the US dollar index.
Yeah, that's why I think like 2017, like January was a peak. I know in 2020 we went back up to like 102.99. And the other thing I did, I started measuring it because the chart goes back to 1969. There's a top in the dollar index, and then it bottomed in 78. So that was like 9 years. And then 78 to 85, that was 7 years. And it's always like 7 to 9 years, so an average of 8 years. So I took like the bottom in March 2008 to January 2017. That was that was like 9 years almost. So I thought that's long enough compared to the other cycles. So that's why I think that was the top. So I'm looking at that as a top. And then from there, it's going to take probably 7 to 9 years to reach another bottom. And I agree with you with the blow off top, and the fact as well that the tops, they're always lower, and the bottoms are becoming lower as well.
Yeah, it's in a clear downtrend, isn't it? So lower highs and lower lows.
It's it's the design, especially when you measure it inflation adjusted, or you measure it in gold or anything real. It's the design of fiat currency. It's just like I always say the same thing. If you give me control, then if I get a lot of it, well, I'm just gonna spend it. And they just, humans being humans, politicians, ever there's an appreciation in what they have, they're just gonna squish it, use it. And then when it's fully depressed, okay, they'll let go of the gas pedal of that spending, whatever, and then they'll keep pressing. And like you've probably, like in history since the beginning of times, all these curves are hockey sticks that go to nothing.
Yeah, I mean, there's a guy he used to called Franz Pick, and he used to actually do currency reports during the Bretton Woods period for central banks, and he was like a journalist. I think he fought in the World War I for the Austro-Hungarian Empire. He was a currency guy, and he said that whenever a government or a state creates a new currency, the only way it will go is down. Because, you can bet that's the top.
Yeah. When you create it, it's the top. I totally agree. Yeah. Or maybe like an IPO, it spikes a little bit, but after that, bam, it goes.
Yeah, like the euro. The euro started at, I think it dropped to like 80, 88, 82 US cents. And then it spiked at 160, and now it's coming down. But the dollar is coming down too. So I've always said that fiat currencies, they're all sinking. It's just that sometimes the dollar will sink faster, and then it looks like the other ones are going up, and then vice versa.
Kevin, just show all gold measured in all the fiat currencies. They look all the same. So that means you're right, because a currency versus a currency, it's a ratio, right? But if you measure it versus gold, they're all dropping just at different moments. Sometimes the euro's dropping faster versus gold. Then after that, it's the US dollar's turn.
Recently, the yen is just like collapsed against gold.
Well, that's it. They're just, handing the baton from one currency to another to sort of lead the charge down the toilet, basically. I mean, it's interesting to see how gold has completely ignored this leg up in the US dollar. And the US dollar has moved from 90 to over 100, and gold hasn't even batted an eyelid. It's
and even from March 08, gold dollar index was at 70.69, the low. And gold, I remember that bottom was corresponded to 1,030. That was the all-time high in 08. And here we are now, dollar at 101 or whatever, and gold is almost double.
Wow. He's right, Kevin. I never noticed that.
Yeah, well, it's very,
see that higher lows. It's like lock stepping. Those wrenches. It locks. Gold. It just refuses to. Man, there was a guy on Twitter today. He says, Patrick, you have to stop. Gold's useless because the dollar is going up. Just look at the dollar. And I told him, no, they could go up together. What are you talking about?
Yeah, there's the first red arrow is the US dollar index going up.
Look at that. The same.
Second red arrow.
They're in sync. If you take a step back, it doesn't matter where the US dollar is going.
Yeah. The whole narrative about dollar going up is bad for precious metals is it's a fallacy.
One guy you have to look up, I'm not sure if he's still alive, but 321gold.com, he used to publish a lot of his analysis. It's a guy called Ron Rosen. and he analyzed gold and silver a lot, and he talked about the running flat correction, and that's something really interesting. What he said was that when gold topped in '08 at 1,000 and then bottomed at 680, right? He said that the move to 1900 in 2011, that was actually a correction. So that wasn't actually a top. And he said what that means is that gold back then was forecasting the collapse of the dollar eventually. Like you see that move there, and then the move in 2011. He said that was a correction, and he said running flat correction is a correction of a market that's so strong that even the correction from a top is to a higher high. And and he said the running flat ended in the end of 2015, 2016, when gold started going up.
You can look at gold using technical analysis to also, lay to rest quite a lot of other false narratives. And one of the false narratives is that where we are now looks exactly like where we were 2011 to 2013. Therefore, gold is going to break down and go to $1,000 or $1,200 or whatever number people want to pick. But looking at the technical analysis, you can see that the stochastic RSI indicator was high and falling into this dead zone when we broke down out of box one. Is that the same as what's happening now? No, it's not, because the stochastic RSI was low and it's now rising into the bullish power zone, as me and Patrick call it. So it's the exact opposite. Same with the 7-year rate of change indicator. We'd climbed from 0 to a high level in 2011 because of the bull market, and we were falling back towards 0 when box number one broke down. Box number two is the complete opposite. We've been below 0 and we've crossed above 0 and we're rising up. So if the conditions are the 180-degree opposite, why would you expect box number two to resolve in the same direction as box number one?
Yeah, and that's really interesting. And I don't know if I can share something with you.
Yeah, of course you can. Go for it.
Running flat correction. I just got it here. Hold on.
Yeah.
Where is it? Share. So here we go. And this guy, he's probably in his 90s now, and he hasn't published much. So I'm not sure if he's still alive. So he says, the forces in the direction of the larger trend are so powerful that the pattern becomes skewed in that direction, running flat correction. So what he was saying is that we had a top here in '08 at 1,000. Then we dropped to 680.
Yeah.
And then he was actually saying that the move to 1920 in 2011 was a correction, and then we moved down to point C, which I think was 1,045 low in late 2015. So he this is what he thinks. The running flat, he says, in a rare variation of the 335 pattern, which we call a running flat, wave B terminates well beyond the beginning of the wave A, as in an expected flat, but wave C fails to travel its full distance, falling short of the level which wave A ended. So it didn't go below 680. Apparently, in this case, the forces in the direction of the larger trend are so powerful that the pattern becomes skewed in that direction.
Yeah,
so it's really difficult to comprehend that, that is a correction from that top, but that this B is a correction from the top in A. So, but what he's saying here, that when you get a new wave 4, wave 5, it's going to be huge. That's for silver. Let's see, that's the silver one. I don't know. He has a gold one as well. I'll find the article in a minute and I'll share it. But gold is the same. I guess the gold would be, that would be 1,030, 680, 1920, 1,045. So that's why I think we're finding so much resistance around 1920 20 right now, but when it goes, I think it's going to be a really, like you said, fundamentally with the inflation that's picking up, it's going to be more like the 70s than the 2000s.
Yeah, I think there's a lot of disappointment the gold hasn't punched through to make new sort of highs on a monthly closing basis. But you have to bear in mind that the spike that we recently saw to 2075, was it? I think.
Yeah,
that was driven on news headlines, and that's never a sustainable.
Yeah, with Ukraine war, wasn't it?
Yeah, it was. And if you're going to make a sustainable break in an ongoing trend, it's not going to be on bad news headlines that are taking place over, it's kind of, need to look at, like Patrick was saying earlier on, it's those key moving averages that are going to drive the price up, because the price always returns to the moving average. Don't forget, the moving average is there for a reason. It's because the price goes above it, below it, above it, below it, and that's what creates the moving average in the first place. So whatever spike you go up, if you become too extended from that moving average, the price is going to snap back like an elastic band. It can't sustain that distance from the moving average. And that's another very good way of knowing when to exit the markets, because you can compare your distance from the moving average from historical distances from moving average, and you can work out, when the risk is high.
So I found this other report, and he's like talking about how the markets forecast the victory of the U.S. in World War II. And with this, I think it was the bottom here in 42, right? Mm-hmm. And then he goes to talk about the running flat. And this, he talks about gold. So this is what he's saying. It is important to recognize that the beginning of hyperinflation was signaled with the advent of the quantitative easing in December 08. Quantitative easing resulted in the running flat correction in gold and silver. Recognizing the running flat correction as the secret signal that hyperinflation is underway is similar to breaking the code that produced the victory in the Battle of Midway. So yeah, he was saying that the Battle of Midway marked the bottom in the stock market, and there was a bull market. So here's the running flat in gold. So you have got the top here, major wave 3, and then A, B, C, and wave 4. So wave 5 is going to be, he thinks it's going to be huge, but you just have to be patient.
Yeah. These moves, they take a long time to work out there. It's just, that's just how it is. But it's going to accelerate, as time moves on. I had a question, man, Mario. Is there at one point, did you ever look like, let's say in the mirror and say, okay, Mario, one day things are going to change. Do you have a list of criteria where you say, okay, look, the gold trade's dead. The government's got everything under control. They're not greedy anymore. Do you think about those type of situations?
I do think about it when it gets frustrating. I try to think, what's the alternative to having, quite a bit of my savings in gold? And I say, well, the alternative is to exchange it to fiat currency and put it in the bank. And then I look, well, are the banks safe? No. Is the government sorting itself out fiscally? No. Are the central banks sorting themselves out? No. Is the rate of interest that I get in the bank, does it cover inflation? No. So I would love to one day for things to be normal, where they're honest bankers, honest politicians, and you can put your money in the bank and earn a decent return. I think you had that probably back in the period after the Napoleonic Wars till 1914 in the UK. You basically had zero inflation, and you could get a decent return for your savings, like 2 to 3% real return when inflation is zero is really good. So it is possible, but now everything is so, I haven't really, it hasn't come to that point for me yet.
That point you made a moment ago about gold predicting what is going to happen in the real world is very true. And with technical analysis, you can identify world-changing events. Just quickly share this chart with you. This was the gold forecast that we issued in 2019, and it predicted that gold would come back to test the edge of the arc at the end of 2019, and then move up to the previous all-time highs around the region of $1,900 to $2,000, then form a pullback that would break out in 2022.
Wow.
And at that point, there's no way of knowing what's going to cause the breakout.
Yeah.
For gold to make that breakout, it would take something significant to happen in the world. Well, of course, here we are 3 years later. Gold did all of those things, and it formed the handle on this cup, and it broke out. And of course, what happened when we broke out was, Ukraine got attacked by Russia. With everything that's gone with that in terms of inflation and global shortages of all sorts of commodities and loss of life and all the other terrible things that are going on, the threat of goodness knows what, World War III, if it all goes badly wrong. But what the point I'm making is that, you can use technical analysis and historic examples to make a deduction about what is the most likely thing to happen. And then most of the time, gold and other investment vehicles will take the most likely path. Of course, the most likely path changes through time, so you have to continually update it. This particular instance, it didn't need updating, but it does just remind people, I think, that fundamental analysis and technical analysis, they're not two separate things. They go hand in hand, and it's good to keep an open mind about that.
The other thing I would say, I don't know if it was you or I think it was another analyst that I was listening to in 2011, 2012, 13, you had the top in 2011 and you never really went close to that top again. But now by having gone up to that top again this year, it means that it's probably not, it means that 2020 was probably not a top, and that the third time we go up there, it's really going to blow through.
Yeah. Well, that's the human psychology behind TA. Is a lot of bag holders or whoever bought there, maybe there's not that many because it's a spike up. But after that, if those people that bought at 16, 17, 1800 on the way up from 2008 to 2011, eventually they might have given up, and that's what creates a base. But eventually when all those sellers are gone, then the price can just like the beach ball analogy, it's just going to levitate. It won't need, it doesn't need new buyers necessarily. It just needs an evaporation of bag holders, of sellers, and then the price just rises up. And then when the price is so high, then you get new buyers and there's no sellers. That's when we get in fear of missing out. And you're going to get 500,000 followers on your YouTube channel there. That's when we sell everything.
That would be nice. But the other thing as well that I've spoken about, I think in the last few years, when the higher the nominal price goes, the scarier it will get, and that's why people need to be aware. It's like, that's why they call it a bull market, because you have to hold on to the raging bull and not fall off the bull.
Yeah, and that's the tough part of it, the human psychology part. As soon as you see it go down 10, 15, 20%, you start questioning the wisdom of your choices. But over a long period of time, we've seen from the charts that we've already looked at now that gold is a barometer. Gold just sits there, it doesn't do anything. Gold just is gold. And the way we value it in British pounds or Canadian dollars or US dollars, that is a reflection of the rate at which those paper currencies are being eaten away by inflation. They're being devalued. So gold will go up at the rate of inflation. It will inflate. The value will inflate at roughly the same level that the currency is deflating.
Yeah, some people don't understand that. They say, well, gold is useless, but money is supposed to be like that. You're not supposed to consume it, or else it wouldn't be money.
Exactly. And the stuff that we call money isn't going to be money forever, is it? That's for sure. It'll need a reset. It's only like I think Rafi Farber, you probably heard of him. Yeah. It's only a money substitute what we use, because originally gold and silver were money, and the banknotes are just a receipt for it. Yeah, absolutely. Yeah, it's goodness knows where this is going to head before we get out the other end of it. But it does feel like we're entering some kind of final stage over the next few
Kevin,
years.
I trust the government. They'll be responsible. Trust me, there's no issue.
I'm
The
sure
thing
that's-
the thing that's worrying though is that yes, you and us know this, but I think the great majority of people are unaware of this, and it's really worrying to see, to realize what's going to happen, and people are going to be like blindsided. They're going to blame everyone and everything except maybe the real culprits, which is really the system, the monetary system. And yeah.
Well, hopefully we're doing a little bit of our part. Like, as long as the chart's saying that this is and that, it's time you have to be long this, then we'll be long it until the charts will tell us when, or will tell us when the things are getting,
And I think with the silver, like you guys have, that analysis is good about the long term. If you get, I think in your video you spoke about projection to 150, but you said it could even go higher if the inflation is a lot higher, right?
Yeah. Look,
well, the key level for silver is $28. Once we break through 28, then we can start getting a little bit more excited. But that sort of 27, 27.5, 28 sort of level. Until we get through that, it's just a time to accumulate and take advantage of the fact that you can still get silver and silver miners at these kind of prices. And don't get upset if it goes down to $21 or $20. This whole time period that we're sitting in now isn't going to last forever. When we all know what happens with silver when it breaks out, it tends to go a bit crazy. So, use the time wisely with silver. And gold is more of a steady investment. I think most
and maybe use the if you like coins and bars, buy those. But if you want to like take some profit in a silver bull market, sell your shares, I guess, your miners, and keep your coins, or you have to work it out yourself. But it depends. Some people like. Hopefully, I have quite a few coins, and I'd like to leave it to my family, one day,
it's a good way of passing wealth on, isn't it? A little bit like
I just bought some $50 today.
Oh,
yeah. Actually, I got it for a pretty good price, equivalent of 22 pounds with the VAT.
That's not bad. That's not bad. Well, those are good prices at these days. It's as I said a moment ago, that those sort of price levels aren't going to be around for forever. And silver, when it does decide to get a move on, it'll be the proverbial train leaving the station with everyone rushing to get aboard. But the charts that we use are roadmaps. Really, they're not intended to be pinpoint accurate, but they're general roadmaps that we're continually updating to try and shine light into the future and shine a light to kind of guide the path. And that's the way I kind of look at the technical analysis. The fundamental analysis and the technical analysis go hand in hand, with one supporting the other.
What do you mean, Kevin? No, it's just classical chart trading. I don't care about narratives, Kevin. Stop it with fundamentals. I like fundamentals, Mario, that I could chart.
I like charts too, but I think those teacups look very encouraging.
I'll give you an example though. The uranium market was fundamentally very bullish for years and years and years. Post Fukushima, the uranium miners fell 60, 70, 80, 90%. And the fundamentals were fantastic. We need nuclear reactors, we need green energy. There's no way the planet can manage without nuclear energy if we're going to, meet the climate change emissions targets. The fundamentals were amazing, but the whole time the fundamentals were amazing, they continued down and down and down and down.
Maybe it was because of it was discounting the political.
And they lost, a lot of them lost 99% of their value.
Wow.
So as soon as they broke out about 2 or 3 years ago, that was the entry point for buying uranium shares. Of course, they've gone up hundreds and hundreds of percent since, and some of them are looking like they're probably going to go up more than 10,000%. Picking that, using the technical chart to identify that breakout point makes all the difference between buying on sort of stuff that is fundamentally good, and one day it'll take off. But in the meantime, you kind of got all your money tied up in that investment and it's still going down. Even if 5 years later it starts to go up again, it's a shame to have your money tied up in that investment. So you can use a chart to pinpoint much more accurately. As I say, it's a roadmap and it tells you when you're crossing a boundary. Anyway, that's my sales pitch for technical chart analysis.
Well, I'm happy, Mario, there that you gave us a shout out there, and hopefully people could bridge, like the narratives or the fundamentals, which are like the questions you answered. It's like, okay, what else am I going to hold other than gold? Am I going to buy Tesla, which I think is overvalued? So the people love stories because it helps them crystallize. It helps them sleep at night, right?
Yeah.
Like for whatever reason, and charts, sometimes it's abstract and people, they have a hard time believing them because they're like, they can't rationalize these moving averages and all that. So they need a real good old fashioned like fundamental story.
Yeah.
But if we're able to make those charts peak out and really show you in a clear way that we're cheap versus expensive, not stretched away from moving averages, then man, that combo is a great cocktail for holding when when there's volatility on the smaller time.
And I think that people are different as well. And I think for me, it might sound, maybe I'm married to gold and silver, but it's like my business, so to speak. And if you're used to one kind of business, you focus on that. But I agree with you. Technical analysis is a really good way of determining whether it's a good time to get in or get out, because you might want to get out as well. If you want to switch to a cheaper asset, or if you need the fiat to for an emergency or whatever.
Yeah, I agree.
Yeah.
All right.
Okay,
fun, man.
It's been a really interesting discussion, and I'm really pleased that we got together and had a chance to speak like this. I think I've been recording this, but I know, Mary, I think you're gonna put this on your YouTube channel. Is that right? So
I'll probably put it on in a couple of days. Probably put it on Saturday or something, or I'll let you guys put it on your channel first, and I can wait. It doesn't.
No. We'll just put it on yours. There's no issue, and we'll share the link through and make sure everybody subscribes and watches it on your channel. There, it's a true honor there. No problem.
Yeah,
no, but okay.
We're both really great. We're both
and next time we'll do it on our channel.
All right. Okay, that's fine.
Cool.
Where are you in Canada, Patrick?
I'm in Montreal, the North Shore, Montreal. I don't mention it's a small town, Sainte-Marthe-sur-le-Lac. I don't mention it because
Parle français.
Yeah. My parents, they don't speak English at all there, but I went to English school all my life, so I'm a hybrid.
Hybrid.
Patrick's picking up English slowly.
Was he joking when you said he wanted to move to the UK? Or?
No. That was
that's definitely
It's not a bad place, aside from all the negatives that we focus on. It's actually a really nice place to live.
I lived in France for, 9 years. I went like France, Canada, and I love the culture, the European culture. I love the like everything. There's so much to learn from absorbing, living, not visiting somebody for 2 weeks. You don't learn you need to learn the ups and downs of a system to appreciate.
The only place I've been in Canada is an island on the one of the Thousand Islands on the I think my dad had a friend from Syracuse, New York, and he had a little island, and it was in Canada. But I think I would like Canada as well, though, because I get a lot of Canadian viewers.
Yeah.
And we seem to get along well. So.
And we're fun. You just got to get rid of our prime minister. Oh, Kevin can't record. You can't put that on.
I'm still recording this.
Justin Castro.
Might have to cut that bit out.
Did I say that? I'm going to get shadow banned by YouTube algorithms now.
Yeah, no, we can.
Wait till Elon gets. Well, actually, when Elon gets a hold of it,
we buy Elon by YouTube. Yeah.
Oh my God.
Free speech. Man. Good stuff.
All right.
Ciao, Mario. It was a lot of fun.
Yeah.